Ladies and gentlemen, it is Tuesdays with Turbo. I am super excited about this one. If you read the description, you know what we're going to talk about. But before we get into that, I hope everyone's having a fantastic week. 70 degrees in the first week of March. I'll take that. I know I will. I know I will for sure. And hopefully it stays that way. It's looking like it's going to stay that way. So yes, I'm not going to jinx it and say spring is sprung because as a Michigander, we all know that there's at least one more freeze coming. Hopefully, it's not a hard one because even at the Jackson household, we have flowers coming up as well as some of our flowering trees budding. So hopefully, that doesn't take anything away from it. But before we jump into this video, my name is Ryan Turbo Jackson. I am your insurance resource, and in videos like this, I like to break down insurance policies, language, give you states of the market, and that's what we're going to talk about here today. And yeah, let me help you because insurance is its own language. And before I jump off on this video, I do want to give a big shout out to my buddy CJ. CJ is an insurance agent down in Tennessee. He is a super knowledgeable person and always has probably some of the most informative insurance content on Facebook. So big shout out to you, my friend. I shared this on my personal page, but I wanted to go a little bit more in depth with it and kind of put my own little twist on it for here in Michigan, and likewise just get this video out to as many people that need it. So if you're not in the market for a home, or if you're not a realtor or a loan officer, go ahead and share this video because I guarantee there's going to be someone on your timeline that meets one of those criteria. So like I said, who is this video for? Are you buying a new home? Are you selling your home? Are you in any sort of real estate, or are you a loan officer? And what I mean by that is we all know we've been to a store, we've been to the gas pump, we've spent money at least at some place within the last 3 or 4 years. We all know that everything is more expensive these days. And insurance is also more expensive these days. And I always tell folks that insurance is always behind the times. Why? Because insurance is based on numbers. What's happened in they use those numbers from what's happened in the past to try to predict what's going to happen in the future. So what we're seeing is, even rewind to the pandemic, we saw some rates that were extremely low, both on the home and auto side, and we even saw some kickback because of that, because people weren't driving as much, and ultimately when the lockdown hit, no one was buying houses. So that was probably, I'm not going to say a knee-jerk reaction, but probably one of the quicker reactions to something that the insurance industry, that at least I have ever seen. So what we're seeing now is, yes, there is inflation, and we're still recovering, or we're still using the numbers that they have. The actuaries is what they're called, the very smart people that really love math, which I'm out on. But they're using the numbers from 3 and 4 years ago to help predict what's going to happen in the next 3 or 4 years. So that's why we're seeing kind of a slow to the game. It wasn't immediate, like some of the other goods and services when it comes to an increase. That being said, the market value for homes isn't the same. We've seen, especially right now, the market is still hot, but not as hot as most people would want because of the fact that there's not a lot of inventory. So there's more buyers than there are homes. So supply and demand, and when supply is low, or when supply is low and the demand is high, the price increases, and as well as your normal taxes on top of that. So, and especially if you escrow your mortgage, you're paying for your house payment, your insurance, and your taxes. Now, checking my notes here. Now what am I ultimately getting at here? Well, what I'm getting at is the days of, and I'm talking in particularly in our area in Michigan right here, auto or home premiums that are below $1,000, we're not seeing a whole lot anymore. And you might be asking yourself, well, why is that? Well, if you look at all the weather related stuff that's going on, all of just society in general, the cost to rebuild a home is more expensive than it was even last year. The cost to, when we're talking materials, labor, and especially what a lot of folks really don't take into consideration is that if there is a total loss to the house, who cleans up the old house? I mean, it has to be the site has to be cleared and prepped for the new house to be built. So that has to be paid for as well. So you're looking at multiple streams of money going out when something like this happens. So yes, if you take a look at your home policy and take your newest renewal compared to even 2 years ago, you're going to see a drastic increase in your dwelling coverage. If you haven't, that might be something you want to talk to your agent about, because as the price of materials, the price of labor goes up, the cost to insure your home goes up. So if you're increasing the dwelling coverage, you're obviously going to increase the premium. Now, what does this mean for buying a home? Well, in loan officers, if I'm incorrect on this, please drop me a comment here. But they do a thing called your debt to income ratio. And with that, they pretty much give you a ceiling as to how much home you can afford. And yes, if you're doing your due diligence and you get pre-approved, which you always should before going and shopping for a home, they take into consideration the taxes, which you can look back and pretty much see what the taxes are going to be. But when it comes to insurance, there's a lot more moving pieces than what a lot of folks really think. And we're going to get into some of those, as well as some of the things you can try to do to kind of lower this. So with that being said, let's get before we get into it, the price, the higher your insurance costs, obviously the more your mortgage is going to cost if everything is escrowed, and that can throw off your debt to income ratio really, really quick. So with that being said, now that I've finished my thought, let's jump into some of these things. Some other things that go into the kind of the premium that a lot of folks really don't think about. We've talked about a bunch of these, but a quick refresher. Every home has a protection class, and a protection class goes from 1 to 10. 1 being the very best, meaning you live extremely close to a 24-hour manned fire department, and obviously 10 being you live out in the boonies. There is no even a volunteer fire department, usually within 5 miles of your home, and a lot of things in between. Now, for instance, Marcellus here, if you live in town, is a 5. And you might be saying, well, Ryan, this house there's a fire hydrant right in the front yard. But because it's a 5, even though you live within 1 mile of the Marcellus Fire Department here, they're still volunteer. So it takes a little longer for them to get to said fire. And the longer it takes to get there, the more likely it's going to be a total loss to your home. So that's one instance. So if you're trying to keep costs down, I suggest getting a home that is very close to a fire station, or and especially around here, probably the closest manned, 24-hour manned fire stations are in Portage in Kalamazoo. So even, and me personally, I really wouldn't want to live in either one of those spots, but it is what it is. But usually your 3 to 5 are relatively common around here. But yes, we do have some 9s and 10s. And even when you get into the 10s, there's a lot of companies that won't write a protection class 10, or even some that won't write a protection class 9 or 10. So that kind of limits you there. So kind of take that into consideration when you're shopping for your home. Another thing is the age of the home. And this is something that I didn't really realize that CJ pointed out in his post, is that when your home is brand new, that's prime, that's optimal. Everything inside it is new, the building is new, the roof is new, your HVAC is new, all of that stuff is brand new, which is the perfect scenario. Now, let's say your home is between 10 and 30 years old. That's where the majority of the claims happen. And this, CJ, big shout out to you. I didn't even consider this, but when your home falls within that age range, that's kind of when all that new stuff is on the verge of needing to be replaced, or is starting to, you're having to start replacing it. Meaning, like I said, your HVAC, your roof, if you live out in the country, your well, things of that nature that are big ticket items when it does come to claim time. So like I said, CJ, big shout out to you on that. I didn't even really consider that, but you hit the nail on the head. And even to go down the rabbit hole further, when you get to homes like they were built in like the 30s, 40s, or even older, that's when you get into replacement costs. Kind of, I'm not going to say a bind, but you see in a lot of these homes where it's plaster instead of drywall. You have ornate moldings and trim and staircases, and as you can probably guess, it's going to cost more to have someone replaster a wall as opposed to re-drywalling a wall. I mean, hell, I don't even know anyone that does plaster work anymore, but I know a ton of people that do drywall. So yes, there can be some functional replacement cost. Yes. And that just means that if there was a loss, it would be replaced with modern things rather than replaced, like use example, plaster to drywall. So kind of keep that in mind too as you're going through your home search, because and ultimately the last thing I would want to do is to not do this video and you go out and you find your dream home, your ultimate dream home. You get your pre-approval, you get, you have the offer is accepted, but the insurance throws that debt to income ratio completely out the window. So that's what this video is for. And let's see here. And some other things to kind of consider is your roof age. Now, if the roof is brand new, awesome. And if the roof, this is something I highly suggest, if the roof is 5 years old or newer, during the home buying process, see if you can get a copy of the receipt or a bill of sale or something that is proof that has taken place. Because all the companies I work with give discounts for newer roofs, but they require proof. So a lot of times we can use the listing, but if you can get that paper in hand, that is gold. And the reason being is that if there was a loss or a claim to the roof, if it's newer and is done right, the sheathing's going to be fine. It's just going to be shingles and all that, and it's not going to be as in depth, which means it's not going to be nearly as expensive, and which is awesome. So, and another thing, and if it's 10 years old, that's still fine. But the 10-year-old mark is where we start to see the premiums increase. And if you get to 20, unless it's in very good shape, 20 years is kind of the max that all of the insurance, at least the companies I've worked with, that will cover your cover your roof at a replacement cost. Meaning, if it's over 20 years, they will still provide coverage, but it'll be at a depreciated value, which ultimately is not what we're trying to do. Because once you start introducing depreciated value into things, that's when there becomes more gray area. That's when it becomes hairy, and that's when you become angry at me when a storm comes through and they're not going to replace, not going to give you the entire amount to replace your roof, which is I don't want that for you. I don't want that for you at all. And lastly, and CJ hinted on this, and this has been a big pet peeve of mine for many years, is percentage deductibles. You might be saying, well, Ryan, what is that? Well, they take the dwelling coverage, and CJ used an example of 500,000, and they put a 1% deductible on it. 1% seems very cheap. Well, 1% is $5,000. And the reason these companies do this is that it keeps the rates, I'm not going to say flatline, but the increases aren't as big, because once the dwelling coverage goes up, your deductible bumps up. So it kind of negates one another a little bit. But if you're not paying attention, next thing you know, like I said, you have the replacement cost on your home is $500,000. You now have a $5,000 deductible. And when you started the home policy, say 10 years ago, the replacement cost was $250,000. And at that point, you had a $2,500 deductible, which in the end is a massive, massive difference. I want to say it was around May or June of last year, so almost a year ago. I had someone come to me that had a 5% deductible on one of his rental properties. And dude had a $15,000 deductible. And he didn't realize it until he needed to make a claim. which was very, very unfortunate. Excuse me. So what's the fix here? We'll either go with a company that offers a dollar amount, $1,000 deductible, 500, 2,500. That way it never changes. Or, like I said, if you do enjoy, those that kind of not up and down, not roller coaster type deals, then that deductible might be for you. But you have to pay attention to it. You have to keep up on it. Like I said, the longer that policy is in place, the more out of pocket your deductible is going to be. So kind of keep that in mind. Well, ladies and gentlemen, that is today's show. CJ's article was so awesome that I wanted to share it verbally on video rather than and give it a little bit more due than just the standard share of a post. So if you are a home buyer, home seller, realtor, or a loan officer, this video in particular is for you. So please take a minute and share this, even if you are one of those or you aren't. This is something that needs to be kind of spread around and needs to be more common knowledge. So with that being said, I will leave you to it. Everyone have a great week, and I will see you next time.